capital. Let's start with Dow 20,000. Much ballyhooed. A lot of people have been talking about it.
Yes.
What would the significance be, if any, of hitting that here in these next few days?
No significance at all for us. So we focus on the S&P 500, which is a much broader group of companies. We think it gives us a better context for what's going on in the overall market. The 30 companies within the Dow, it's just not broad enough for us. So psychologically, I guess it's important to hit 20,000. Doesn't really matter for us when we think about the overall market, though.
Remind us of your target for the S&P for 2016.
2,200.
2,200, all right.
So we're a little bit above it. Looks like we might have come out a little bit low this year, but not too bad.
Let's move ahead to 2017, your target for 2017, and sort of what the factors will be as you see them that might lead to that number.
Yep, so we came out with a price target of 2,400 for 2017. Basically saying we think upside for stocks next year is around 7%. Add in dividends, you probably get to 9%. The way we approached conveying that outlook to our clients was through a series of predictions. So we made a prediction for where we think earnings are going to go next year. I think that's very important as a driver for the market. We made a prediction around where dividends are going to go. We think they keep going up. We made a prediction around buybacks, which has obviously been a big driver of the market this year. And then we set our price target and made a prediction around the sectors. When we put all those pieces together, we think you do have good upside over the course of next year. This is one of the more bullish price targets we've set. We think 2,400 is the right target for going into next year.
Well, let's dig into a few of those there,
Yeah.
starting with earnings. What do you think is going to kickstart earnings growth here in the new year?
Yeah, so we've been talking for the last 2 years about the lack of earnings growth for the S&P 500. We think those days are over, and there's a few drivers behind it. So first, we think you are going to get a rebound in sales growth, which has really been a missing ingredient for 2 years now within the market. A couple things are going to cause that. You have better growth here domestically. You're also getting better growth abroad. We think that's going to allow companies to push their revenue, their top line, above where it has been. So we think you get nice top line growth. There's a few offsets that drag it down, things like a strong US dollar and higher wage costs, which are hurting company profit margins. But overall, our baseline assumption is that you get earnings per share that reach around $127 next year, which will be the best result we've seen in over 2 years. Now, here's the thing. We think there's actually upside to that number.
How many chapters are left here in the story of the stronger dollar? You mentioned the strength of the dollar we've seen here. How long do you think that's going to continue?
Well, that actually plays into this upside that I see for earnings, and I'll tell you how. So we think the baseline is you have earnings growth of around 7% next year, but if the tax cuts that President-elect Trump has been talking about come through, we think their upside is quite a bit higher. So you could actually see earnings per share growth next year upwards of 12%, something we haven't seen in a long time in the market, if you get the tax reductions that I've been talking about. Now, here's the thing. When you think about upside for earnings, you can't just take the tax cuts, the good things, without some of the negatives that may come. So President-elect Trump has also talked about tariffs.
Sure.
We think some of these policies, including the higher interest rates that we're seeing, could lead to significant dollar strengthening over the course of the next year. So you said, what chapter are we in?
Yeah.
We think there's more to go in terms of the dollar strengthening. Now, here's how to look at it. Every 1% increase in the dollar reduces earnings per share for the S&P 500 by about 1%. So we're saying in our model anyway, you might get 8% dollar strength next year, which will hurt EPS growth by about 8%, but net, the tax cuts are even bigger, and so you should expect potentially quite a bit of upside for earnings.
Okay, so there's the tax cuts. There's been talk of a repatriation holiday here. How does that factor into your forecast for buybacks?
Yeah, so it was very important. We debated this a lot. When I look at buybacks, I say we have hit the peak, and they're not going to go up from here. And the reason we feel that way is because leverage has gotten so high, right? Companies over the last 4 years have been buying back more stock than they can afford. And they've been able to do that by borrowing more and more money. But now we think they've gotten to the point where they just simply can't continue to borrow money. And so you should see a plateauing of this buyback activity. The potential for a repatriation holiday is the big wild card with that estimate. In 2005, the last time we had a repatriation holiday, you did see a significant increase in buybacks. Now, granted, we were at a different point in the business cycle and conditions were improving, and that also contributed to it. But you did get that increase. If you have a repatriation holiday again, which is, as you mentioned, part of the tax.
Table,
yeah, it's on the table in the tax proposal, you would argue that companies have more financial flexibility. Often they take that and they use it to repurchase shares. So I would say our estimate for buybacks is they're flat next year, but potentially biased upwards if you do get that repatriation holiday.